Hello, friends. Today we're taking a look at Airbnb, ticker symbol ABNB. We'll be looking at the stock performance in the past 5 years, the latest earnings report, then we'll jump into the fundamentals and try to find a fair value for this stock. Welcome to Money Talks with Martin Reyes, where we learn to take care of our money and find great companies at great prices. Looking at the stock in the last 5 years, in the last 5 days, it is up 7%. And that has to do a little bit with the news that they are raising their service fee by 2% booking. So that will be increasing, helping with the growth in the revenues. In the last month, they are up an amazing 13.6%. This past year, it's been going up and down, but they're up 40% from last January. And in the last 5 years, it dropped after the whole COVID era, and it went down almost all the way to $85. That would have been a beautiful purchase, almost doubling. But since 5 years ago, it is up 125%. So when we look at analysts, most of them think that the stock is overpriced. They have a hold on this stock, and they're looking for a target price of somewhere around $139, $138. That will be almost a 10% to 9% in the down direction. So overpriced by about 10%. They're going to be reporting earnings on February 13 in about 2 weeks, just before Valentine's Day. So that will be a good time to listen to the earning calls and see how they are doing. The price is close to their 52-week highs of $154.95. P/E ratio is at 18.4%, and the forward is at 34%. The reason why we're talking about Airbnb is because about 2 months ago, Joseph Borja, one of our our subscribers, suggested that I analyzed it. I forgot about it. I'm sorry about that. And then he kind of reminded me a month ago. This past month has been crazy for me. So I am finally jumping in. This is one of the reasons why you should not be making financial advice based on my analysis. I do appreciate that you wanted to hear my comments and thoughts about this, and I really appreciate you guys suggesting this. But if, let's say, Joseph had decided to just buy 2 months ago, he will be up 20%, 21%. Or even if he just tried about a month ago, he will be up almost 10%, 8.5%. So just a reminder, I love giving you my opinions, but make your own decisions based on your own research. If you would like to get the tools that I use to research stocks, I will let you know about that later in the video. So stick around. And they announced earnings on November 1st, and they beat by a lot. I mean, they beat by a lot. That is almost 200%, which is crazy. EPS normalized, they beat by $4.48. This is actually the actual results. So that means that they were expecting 2 point something. GAAP, also they beat in revenue by 28%, which is 28 million, which is not that much, which tells me that they probably got better on their margins. So if you're investing on this, I will highly encourage you to go back and look at their numbers, look at their financials. Now, when it comes to the upcoming earnings report, they are looking at very low EPS numbers. I mean, they're going from 6.36 $6, which of course this is a beat. So even if you were expecting $2, they're cutting it way under it. So that would be something for you to look. Why are they doing this? And not only that, look at this, the EPS revisions, they're going up in the past 90 days. 30 of them, all of them, 100% of them are going up. So I will highly encourage you to analyze before you jump into this company. I am doing a brief, just checking a couple of things and giving you my opinion, a quick scan of this stock. And remember, I am not a financial advisor. Key measures that they reported on Q3 is their revenue was $3.4 billion, which is an increase of 18% year over year. That is great. Also, they reported a net income of $4.4 billion. Adjusted EBITDA was $1.8 billion, which is a year over year of 26%. Cash flow is up. They reported 1.3% for the trailing 12 months is 4.2 billion, which it will be a 44% increase of their 44% free cash flow margin. That is a really great number. Now, there's a couple of metrics that this is more for Airbnb. Gross booking value, which is the nights the people are what they're paying. It's $18.3 billion. That's an increase of 17% year over year. So that is there's a lot of growth with this company. So if you like what I am rambling so far here, please leave a like. If you like the channel, please subscribe and let me know anything that is in your head related with these things. Any comments, any questions, any suggestions. Let me know if you like the new style that I'm trying in these 4 videos that I'm making, in which is more conversational with you, just a little less stress for me. But if you just like the numbers and you don't like me to ramble and talk so much, please let me know so that I can change my ways. Also, let me know if I miss anything related to this stock, if I mispronounce anything, which I tend to do. What is your bull case? What is your bear case on this stock? Let's jump into the valuation, my spreadsheet. Now, the issue with Airbnb is that it didn't went public until 2016 or 2017, somewhere around there. So we don't have 10 years in order to be able to analyze. And yes, this company, of course, is cyclical. Okay, meaning for those that are new into investment, and that means that they don't have a regular. People are not always spending regularly. They're not growing. It depends on the cycles of the economic cycle. So whether we're in recession, whether we're in growth and stuff like that, that always affects their. When people have more money, they spend more on vacations. Whenever they have less, they go a little bit down, and it goes like that. So in the last 5 years, they are flat, and that's because they're comparing to 2008, but they have been growing pretty nice since 2021 after COVID restrictions were lifted. Earnings. This is another issue that normally happens with new companies. As they're launching, they're mostly not making money. They're not profitable. They just became profitable last year, and right now it seems like they are in a good pace to be profitable also for this year. So this is good for people that are investing in this company. When it comes to free cash flow, Free cash flow, they have been positive most of the time, except in 2020, which makes sense. And the cool thing is also that it seems like they are growing. In the last 5 years, it has grown at 27.4%. Free cash flow margin average was 14%, and we just read that trailing 12 months free cash flow margins are at 44%, right? Is that what we read? That is quite a jump. Yes, right here. Let me just make it a little bigger. 44% trailing 12 months of free cash flow margin. That is almost a 30% growth, right? Am I doing my math right? 30, yes. 30% growth on margins. That is great from management. So book value per share, their book value have been going up, and I don't have stats because there's not too much data. The only thing that I can tell you is that based on my numbers in the last 5 year, return on equity is at 13.9%, which is not bad. But now remember, those numbers are going to be skewed because they have a lot of bad years, right? In those 5 years, probably the first 2 or 3 numbers are going to be low. Return on invested capital are at 14% and return on asset at 5.7. Actually, you know what? Let's look a little bit behind. And over here, you can see, let me see if I can make it bigger for you. So return on equity has grown. It was negative. And now in the last 2 years, it's been 35, almost 36% and 38%. When it comes to return of invested capital, it goes to 22 to 34% trailing 12 months. And return of asset goes from 11 to 28. Those are great. This is the numbers. You see how they're all negative over here. They are going the right way. So that is good to see. When it comes to dividend growth, well, they're a new company, so they're not giving dividend. They're just growing the company. Debt is actually not bad anymore. It used to be a little bad, but now that they're producing all of this nice free cash flow, they could pay their long-term debt at in about a year, less than a year. A year and 3 months with their free cash flow. Shares are going up. They have gone up almost 21%. This is not good, but it's normal when a company is trying to expand, right? Instead of borrowing money and making this worse, what they do is they issue shares so that there's more investors, and that's how they get the equity, and that money they can use it to expand the business. Analysts are thinking that Airbnb will be growing 22% in the year over year for the next 5 years, which is awesome numbers. So we're gonna jump and try to give this a valuation, but I'm just gonna be honest with you, this is gonna be a little hard because we don't have too much data. Also, a disclaimer: I am just a YouTuber that love talking about stocks and finance. So this is just for entertainment purposes and educational purposes. I'm not a financial advisor, so please make your own research before investing. Do not make financial decisions based on my opinions. So there. Let's jump in. When it comes to multiples, valuation, I'm just using the revenue, the free cash flow, and the book value per share. It gives me an average number of somewhere around $182. So that would be $140 to $225. When we use the payback time valuation, gives us a number between 100 and 160. Can you see how the numbers are so far apart, and that has to do with their the this valuation tools that I use are mostly for businesses that are established already. So just giving you a little bit, you'll see the big numbers. So for example, here in the discounted earning valuation, you will see that the average EPS is negative, while and it will be negative value. And then if we just take the trailing 12 months EPS, that will be $152 fair value. When it comes to earnings valuations, once again, the same thing. The averages are not as good as they're doing right now. So it shows a $10 all the way to $165. Anyway, when we put everything together, you could argue, at least I'm going to try to make the argument, that a fair value will be somewhere around $146, which analysts are thinking that it's somewhere around 138. Well, that's where the price is going to go, not necessarily there's where it's value. So with all of this, if I were to jump into this company, I will need quite a margin of safety. I will probably need a 30% margin of safety, and that will put me back, I think it's in October, the October numbers, somewhere around there. No, actually last year's. It will put me somewhere around the May of last year numbers. I will be okay paying somewhere around $105 for it. But it seems to be a really nice company that is growing, has a lot of potential. I would highly encourage you to continue to analyze it. If you would like a copy of my valuation sheet, and then you can make your own changes and stuff, the link is in the description down below in my Buy Me a Coffee website. If you want to support the channel, you can do it also there, or just the cheapest, the freest way that you can do it is just by leaving a comment, leaving a like, and a subscribe. I hope that you enjoy the channel, the video today, and let me know if there's anything else that I could do for you. If not, I'll see you in the next video.